Howdy, y'all. Welcome back to the weekly economic update for Monday, November 28th, 2022. Hope everybody had a fantastical weekend out there in the interwebs. It was a pretty nice week here. Got to watch a lot of basketball, which was, I love sports, so it was great for me. And got to watch a lot of college football. The Knowles kicked the crap out of Florida, which was nice. And see, everything else, unfortunately, the market didn't seem to like today. Unfortunately, we have a lot of red across our screen here. Even the overnights were not very good either. So, all right, if it's your first time watching, please give me some thumbs up, like, share, subscribe. I would greatly appreciate it. And let's go ahead and jump into the news of the day. Starting out with the markets, the Dow Jones was down 1.45%, closed at 33,849. The S&P 500 was down 1.54, closed at 39,63. NASDAQ down 1.58, closed at 11,049. Small caps were down over 2%. The VIX was up today, 8.34%. It's currently sitting at 2221. Let's see here. Canada was down 0.8. Brazil was down 0.18. Mexico down 1.14 for the day. Jumping across the Atlantic, earlier today, Germany was down 1.09. UK was down 0.17. France down 0.7. Eurostox was down 0.68. Netherlands was down 0.33. Looks like the Spanish markets were flat. Italy down 1.12. Switzerland down 0.05. And Portugal down 1.01. Let's see here. The Russian exchanges were both red. The MOEX was down 0.81. The RTSI was down 1.63. And overnights in Asia, Japan was down 0.42. Australia down 0.42. In China, the Shanghai down 0.75. The SESE component down 0.69. China A50 down 1.2. DJ Shanghai down 0.88. Hang Seng down 1.57, and the Taiwan weighted down 1.5. So looks like for most of November 28th, it was not the best day in the markets, unfortunately. But again, like I've been saying, personally, I felt that the rally was going to run out of steam at some point, and we may be looking at that right now and have an article to finish up the broadcast talking about that. So, all righty. Let's go ahead and peruse this week's weekly economic update. The week on Wall Street, growing optimism that the Fed may be ready to ease future interest rate hikes sent stocks higher in a quiet trading week. The Dow Jones Industrial Average was up 1.78% last week, while the S&P 500 added 1.53. NASDAQ was up 0.72, and internationals were up 2.33. Stocks rally. In light holiday week trading, stocks rallied as investors grew more hopeful of a slowdown in future rate hikes. The release of minutes from the early November meeting of the Federal Open Market Committee fed investors optimism. Fed officials suggested such easing may be coming soon. Again, I personally think that rates are going to have to get up to about 6 or 7% before it's all said and done. The Fed may choose to take a step back, slow down their rate increases, but I think it's going to wind up kicking them in the nuts really hard. And it's, kind of like what Paul Volcker did back in the early 80s. He tried to take a reprieve, bring rates back down, and then, inflation just continued to surge, and he had to do a second round of rate increases up near 20%. So jumping back in, investor sentiment was also lifted by unexpectedly strong retailer earnings, upside surprises in new economic data, and better than expected consumer sentiment reading. Investors looked past the continuing COVID-related challenges that have stymied China's economic recovery and its attendant implications for global growth. Yeah, if you've been watching the news over the weekend, looks like they've got some unrest in China with their zero COVID policy. So we'll see what happens. Personally, as a libertarian kind of guy, I kind of like to see the people pushing back on government. There's not enough of that here. There's too many lemmings who just do whatever they're told. But anyways, easing in the offing. The Fed minutes released before the Thanksgiving holiday showed that most Fed officials felt a slowing in interest rate increases would be appropriate. The minutes also suggested that such a declaration in rate hikes may begin with December's meeting with a 50 basis point hike rather than a fifth consecutive boost of 75 basis points. The primary reason for slowing the pace of rate hikes we are were the growing risk that the Fed may increase rates beyond what was required to reduce inflation to its 2% target, and signs that inflation pressures were easing. I will agree, it does look like things are starting to slow down, but again, it's kind of like putting out a fire. You don't want to turn the water off too soon, and then you have it flame back up, and you're dealing with the same problem all over again. All right, this week's economic data coming out. Tuesday we have consumer confidence. Wednesday we have GDP, the ADP employment report, job openings, and labor turnover survey. Thursday we have jobless claims and the Purchasing Managers Index of Manufacturing. And Friday we have the employment situation. Just a handful of companies reporting earnings this week. Tuesday is Workday, Intuit, and CrowdStrike. Wednesday is Salesforce. Thursday, we have Marvel Technology, Dollar General, and the Kroger Company. All right, so that's everything there. Let's go ahead and read through today's market recap, see what happened while the market was open. Dow wobbles as China unrest rattles stocks. Woo. The Dow fell sharply Monday as investor sentiment was hurt by Federal Reserve officials reiterating a stance for rates to remain higher for longer at a time when the impact of civil unrest in China stoked fears about slowing global growth. Federal Reserve Bank of St. Louis President James Bullard said markets were, quote, underpricing risk that the FOMC will have to be more aggressive rather than less aggressive in order to tame the substantial inflation in the U.S., end quote. Bullard had previously said the Fed may need to lift rates to within 5% to 7% range. The remarks arrived on the heels of comments from John Williams, president of the Federal Reserve Bank of New York, who echoed that inflation was, quote, far too high, end quote. The remarks soured investor sentiment further, pushing the broader market deeper into the red following a tepid start to the week amid reports of social unrest in China over COVID restrictions. Quote, from an economic standpoint, China's zero COVID policy has already had serious implications for growth, end quote. Stifel said, citing China's third quarter economic growth of 3.9%, well below its official target of 5.5%. Tech led the move lower, pressured by Apple, following reports that the tech giant could see a production shortfall of 6 million iPhone Pro models because of disruptions from supplier Foxconn in China. Others on Wall Street were also flagged concerns, with Wedbush estimating iPhone shortages that, quote, could take off roughly at least 5% of units in the quarter and potentially up to 10% depending on the next few weeks in China around Foxconn production and protests, end quote. Microsoft and Meta platforms fell more than 2%, with Alphabet slipping more than 1%. Energy stocks also fell victim to reports of social unrest in China as oil prices fell on concerns about softening demand in China, the world's top energy exporter. EQT Corporation, Pioneer Natural Resources, and Diamondback Energy were the biggest decliners in the energy sector. Consumer stocks also ended the day in the red, though losses were kept in check by rallying casino stocks, including Wynn Resorts, Las Vegas Sands, after receiving provincial licenses from Chinese government to continue operating in Macau. In other news, Taboola surged nearly 40% after announcing Yahoo had taken a 25% stake in the advertising company as part of a 30-year commercial agreement in which the company will provide native advertising services. All right, so not everything was terrible today. One company had a nice return. So, all right. And last thing we're going to cover today comes from our friends at First Trust Financial. Brian Westbury, their chief economist, wrote this. It's titled, This Rally Shouldn't Last. Let's go ahead and dive in. It's that special time of year, and we all hear and read a great deal about Black Friday, Thanksgiving weekend, and Cyber Monday during the next few days. Many pundits are going to make sweeping conclusions about the economy based on these very limited reports. Our recommendation, please feel free to ignore this news. Christmas time spending is a marathon, not a sprint. Slow sales early could be bad news, or it could just mean shoppers are waiting to pounce later. Fast sales early could be good news, or it could mean consumers are getting tapped out sooner. Past patterns are no indication of this year's results. Even more important, it's not how much consumers are spending that matters, but how much the economy is producing, which is the ultimate source of future purchasing power. Instead, focus on fundamentals like monetary policy and corporate profits. It's these fundamentals that determine the path of future markets in the next year or so. And in regard, the near future is flashing many warning signs. With results in from 97% of S&P companies for the third quarter, according to FactSet, it looks like corporate profits are only up 2% from a year ago. We would not be surprised if The GDP report due Wednesday morning shows economy-wide corporate profits fell in Q3 and giving bottom-up earnings estimates so far continue to decline in Q4. The stock market depends on two factors, profits and interest rates. As the Federal Reserve has lifted short rates, the entire yield curve has risen, and higher interest rates have been a big drag on stocks. Now, stocks look like they'll also have to grapple with stagnant to declining earnings. This is why we think the recent rally does not signal the end of the bear market, just like the rally from mid-June through mid-August, which ended with the S&P 500 peaking just north of 4,300. The lowest close so far this year was 35.77. We think the market will test that low and likely go lower before the next recession is through. The only way the recent rally turns out to signal that the worst is behind us is if the U.S. somehow avoids recession, but with monetary tightening, avoiding a recession is unlikely. This is especially true when we add in the fact that much of the economy, especially in the goods sector, has to get back towards normal after being artificially supported by trillions of temporary stimulus in 2020 and 2021. Yes, some recent economic reports have been solid, including retail sales, manufacturing output, and new home sales. Meanwhile, jobs have kept growing. But the link between tighter money and less economic activity is long and variable. Back in 2020 and 2021, we consistently said that the bill for massive overstimulus would eventually come due. We are now much closer to getting that bill. Don't let the time lag or the belief that the Fed can reverse course just in the nick of time convince you it's not coming at all. Oh, and I didn't put that on the screen. I apologize. All right. Well, if you want to see it, there was the text of it. So it's attached in the show notes. If you want to watch it or want to read through that on your own, feel free to do so. They always have really good materials there at First Trust. So, all right. Well, that's everything I had for today. If anyone needs anything from me, please feel free to go to dsafinancialgroup.com. My email is right here on the screen if you want to shoot me an email. And all my other contact information is on my website. So feel free to do so. All right. Well, like I said, that's everything I had for today. Hope everyone has a fantastic Monday evening. And I'll talk to you next time. Adios.